I think since World War II, you take a look at some of these historically military invasions, and you see heightened market volatility for a few weeks, and then you don't see that much lasting impact. Kind of what we saw yesterday in a way. Do you think this time is different?
It's always dangerous to say the phrase "this time is different." But if you look at historically, in general, financial markets tends to react in a rather short-lived fashion to major geopolitical events. We have seen that in the past with the invasion of Crimea in 2014. We've seen that in the Iraqi war in 2003. And, post weeks or days after the invasion, typically markets have bounced back. So it is rarely a good time to be, for investors to be pressing the panic button at this point in time. But obviously, the situation is still very, very fluid. And so for investors who are concerned about further escalation, then it's natural that they might want to then consider some sort of a risk hedges on their investments allocation in the next coming days and even weeks ahead.
So is there anything that, in terms of what you're seeing in terms of the flows, the trends that you're seeing, is there anything that you would fade at the moment, and what would you actually chase?
So if we look at the current situation today, we continue to remain overweight on global equities, but certainly with the increased uncertainties from Ukraine and Russia, we advocate our clients and investors to add on risk hedges. For example, gold, which just broke through a key resistance, and gold also benefit from the lowering of nominal yields, or in this case, we have seen a pullback on U.S. Treasury bond yield, and that's going to support gold going forward. And at the same time, investors can also consider yen, for example, because that's a relatively cheap currency, and it has also been traditionally a safe haven asset as well for during risk-off events. And last but not least, we also think that investors can also consider Chinese assets because Chinese assets tends to be a little bit less correlated to the global economies. And if we look at what the Chinese authorities are doing today, they are embarking on a very, very different, in fact, I would say outright opposite regime, right, compared to what the Fed is doing. The Fed is looking to further tighten monetary conditions, whereas for PBOC, they are looking to ease and stabilize growth into 2022.
Okay, Audrey, once or if this goes away, the Ukraine story, and that's still a big if, then what then becomes the strategy? So
if it indeed goes away, then certainly I think buying on dips behavior would be on full display once again. And under that scenario, some of the more risk-on assets, whether it's China, whether it's emerging markets for that matter, would probably stand to benefit. We would also see the likes of European as well as U.S. equity benefiting from that. If you look at the current correction so far, certainly European area equities has been much more deeply hit because of the direct impact from the potential risk to the energy supply. But should this risk go away, and we've seen the incursion maybe mellowing down to something even more localized, then surely the European equities related assets will probably perform better.
And anything to avoid very quickly?
Well, I think don't press the panic button as yet. Right now, the market has corrected quite significantly already. So if you really, for us, we'll be really thinking about when to deploy some of the cash to really play the rebound, because that's what history is telling us. These sort of geopolitical events tends to be short-lived in terms of the impact on the markets.